Good morning, everyone. Thank you for joining the seminar that we're having on the challenges facing commercial and investment banks in funding a just transition. My name is Saul Levine from Trade and Industrial Policy Strategies, or TIPS, and we're going to be starting in about a minute. I was waiting for a few more people to join the session. We had over 100 confirmations, so I'm sure there'll be a few more joining. We currently at about 40. So let's just give people a chance to join in. Just while we're waiting for them to join, please put your questions in the Q&A in Zoom. I'm sure you get reminded at every Zoom webinar that you're part of, but it would be great to have your inputs and your questions on the Zoom Q&A. There's also the group chat, which would be a great place to just also put some of your ideas and thinking that you have on the issues. So please feel free to use it. We've got a number of people joining us today. Okay, we do have that critical mass. So I think let's kick off then. So our discussion today on challenges facing commercial and investment banks in funding a just transition is very apt. We are facing a massive climate crisis, but also the social aspects that are absolutely critical to deal with. And how do we diversify our economies away from the mono economies that we have in certain towns? How do we move to a different trajectory that sees us less reliant on coal, but also supporting new types of industries that enable a transition to take place smoothly and with less social disruption? These are issues that are confronting us, and in the build up to COP26, which is in a few weeks' time, we're seeing how important they are and how important it is for us to have these discussions, get our head around some of the challenges, and then start working towards the change that needs to happen. So we have a very impressive lineup of speakers today who are going to be sharing their insights. I'll introduce each one as they come due. I'll start with that shortly, but just a few issues that have come up. We all know we have the ESG frameworks that we've got in place. How do we give weighting to those ESG frameworks? Where's the importance? Where does the importance sit? And how do we bring in the just transition aspects into our reporting, our metrics, and how we operate is a very key issue, and we'll be getting some insights from a range of different players today who have been thinking and working on these issues. So I'm looking forward to the discussion. Some of the key issues that we had put in the invitation, if you had seen the invitation, is just how do we think about the types of funding that need to take place to support a just transition, the big investments, but also the smaller investments that are going to be slightly different to the usual funding that is provided by the finance sector, and with different players now getting involved, different technologies that aren't always proven. So these are some of the challenges we've identified in our research. And just on that note, we are presenting our own researchers' tips in a session tomorrow with the Presidential Climate Commission. And you're welcome to join in that webinar. Some of you may have already registered for that webinar. So on that note, I'm not going to hog too much of the limelight as facilitator and abuse my position. I'll now start calling up our speakers. We've got 7 speakers today, so we'll give each of them 5 to 7 minutes to talk. Some have got slides, and we'll then have at least half an hour for your comments and discussions from the audience. And if you are interested in speaking, you're welcome to raise your hand to unmute once we've had all our presenters giving their inputs. Okay, so let me go over to our first speaker, and that is Deepak Patel, who's the head of sustainable finance as part of the Secretariat for the Presidential Climate Commission. Deepak, over to you.
Thank you, Saul, and good morning. fellow panelists as well as attendees to this webinar. Let me say at the outset that we stand at quite a momentous crossroads. I know that might appear to be melodramatic as a statement, but since the IPCC report, which beyond any doubt indicated that human activity is in fact now responsible for climate change and global warming, I think over the last 2 to 3 months, what we've seen is a crescendo, not only of voices, but all sectors falling in line with an, let's just call it, understanding that this transition to net zero in 2050, as well as a process of decarbonization undertaken with specific reference to the conditions in each country, is now, rather than lip service, is a process that we need to undertake. I'm going to start very quickly by saying that the Presidential Climate Commission is a presidential commission, obviously. It was announced and created in December of last year, with the commissioners coming from a very broad range of societal groups, as well as stakeholder and interest groups, being announced in February. So really the PCC got going in February of this year. Some people might say, well, here's yet another commission. I want to say that the commission is an interim step to a legislated body coming into existence through what we hope will be the Climate Change Act, which at the moment is a bill having been passed by the cabinet 2 weeks ago on the 14th, and will now enter the parliamentary process. Having said that, the Presidential Climate Commission will obviously look forward to being formalized as a statutory structure as we go forward, but leading up to COP26, as colleagues and fellow panelists will understand, there is an imperative to get a country consensus. So what is the PCC and what is it intended to do? It has, in terms of its terms of reference, been given the power, the authority to have conversations with a whole range of social partner groups, will operate on the basis of the recently decided upon second NDC, which I think other speakers might address, but it was quite influential in ensuring that the second NDC that got approved was in fact an ambitious statement and a hugely advanced, tighter, lower bound range than what we offered in 2016 at the Paris Agreement. The Presidential Climate Commission has also very early in its life established the primacy, the centrality of a just transition as we undertake this journey towards a decarbonized future, and in fact has now quite vociferously indicated that there can be no green transition, decarbonization pathway unless we have the just component of that transition firmly embedded as part and parcel, not a sideshow, not something that is ancillary, but in fact embedded in this transition. I know that today we're talking to commercial banks and investment banks, and therefore I want to very, very quickly get to the point of maybe sketching some of the challenges which I think they will be facing. If I may, I'm going to try. Apologies if I don't get this right, but I'm hoping I do. I'm going to use, is that okay, or do I need to move to screen sharing? Apologies.
No, we can see your screen. Just go to full screen, please. Perfect. Go for it. You need to unmute.
I'm sorry about that. These are just boxes which I thought are relevant to commercial banks as well as investment banks, and in broad terms, the financial system. As we undertake this journey, a number of things need to be considered. With respect to prudential and regulatory environment, what we can expect, and I think the speaker after me, Gert, will address some of these issues, but with respect to risk management, there is both the risks to the banking sector of climate risk, but just as importantly, as we know, when we come to portfolios and the concentration risk that sits in the majority of our commercial banking books that are still exposed to fossil fuels, that transition needs to be undertaken, and each bank within its own competitive framework, but also within its own regulatory, within the broader regulatory environment, would have to start balancing or transforming their portfolios. With respect to the fiscal and economic environment for the country, as we know, we've got severe debt to GDP constraints, that whatever we choose to do needs to be, broadly speaking, within both the fiscal envelopes as well as make a contribution to economic development, and that our path to a just transition, or the just transition, needs to be growth oriented. We have a number of macroeconomic constraints, which I won't go into detail and hopefully will come through in the conversation. Then, of course, there's public policy. And there are people who argue, why is the Minister of Minerals and Energy speaking with a counter voice? I think we need to understand that this transition is very complex. It is complex because it affects people's lives. It's also complex because it fundamentally alters the base of our economy. And each minister has a portfolio of responsibilities. So while some people might see this as contradictory, within government, certainly I think there's a view that says we need to harmonize and reconcile, and that the Minister of Minerals and Energy does in fact have a mandate to both protect jobs in the sector, as well as protect the interest groups and the asset base that the country is endowed with. And therefore, what we need to find through the just transition is a harmonization as we move forward. Of course, there's technology development, and here I think the banking sector, as well as the private equity sector and the development sector, is hugely important. As we undertake this journey, we must ensure that we don't become takers of technology developments elsewhere in the world, relegating us to essentially an implementer of other people's IP and technology. And we, I believe, have enough capacity in this country, both financial as well as innovative, to ensure that as we undertake this green journey or greening journey, we do so with full regard for our own industrial and competitive capabilities. ROI and IRR, I'm going to very briefly say that the conventions that currently exist need to be revisited. And here the investment banks in particular, I think, have a challenge to find the answers to a new type of determination of viability. I think Sandy later will talk about the challenges related to the smaller project sizes, but also the unconventional projects, which might require a completely different approach to both risk measurement as well as return measurement. And finally, of course, with respect to financial flows, we know that we have been fairly good at managing the capital that is required in our mitigation efforts through the REAP programs. However, I need to caution that those REAP programs were, in fact, from a viability and bankability point of view, premised on the offtakes, i.e. the power purchase agreements that were entered into, as well as performance and other types of guarantees that got given by government. We need to ensure that as we move down the path of risk mitigation, well, firstly, mitigation in carbon, and then through the project life cycle of our technology developments, we need to start passing on risks to those places where it can be best bared. With respect to ESG, Sol and I were talking earlier, it is reasonably well established within our corporate governance framework that both environment and society are quite integral to the process of corporate, let's just call it citizenship. But as we move forward, clearly there's going to have to be a rebalancing, a deepening, and in fact, a maturing of the way in which we look at the environmental and social factors in governance of corporates. Here, of course, as it relates to banks and investment banks, the large banks, as well as the smaller boutique capital raising outfits, we need to start looking at how we not only embed ESG as a firm component within our own DNA, but in fact, from a bank's point of view, as we move towards rebalancing portfolios, what is the imperative then of the banking system to also begin to promote an environmental and socially aware path to decarbonization as it builds solutions and in fact gives financial innovative structures to its corporate clients. Sol, I don't know how long I've been going, but I'm going to stop there. Thank you very much.
Thanks. I think it's a good place to end off, because it provides a basis for some of the upcoming discussion. I'm now going to hand over to Gert Kruger, who's the Chief Risk Officer at First Rand Bank. Gert, over to you. Thanks.
Thank you very much, Saul, and good morning to everyone. I would like to highlight 6 particular challenges that the commercial and investment banks are faced with when financing this just transition. The first one is we often talk about a just transition, but in fact, there's multiple transitions taking place concurrently. There's a transition specific to each industry, and there's a sequencing issue between industries. Let me illustrate. If you look at the sequencing between the electricity grid decarbonization, as well as the coal sector, as well as the synfuel sector, as well as the automotive sector, those need to be sequenced, and those have got particular nuances. So if you want to finance this effectively, one need to have a common fact base in terms of the sub-transitions taking place and the sequencing of that, so that you don't compound the problem. The work done by the NBI gives a very good fact base on that. And then, of course, one ideally want to have public policy and these private sector think tanks work harmonized. So you've got a common fact base from which you finance from. So that's the first issue. The second issue is dealing with the 2 extremes in terms of concentrations. On the one hand, you've got very large concentrations like Eskom. It's not possible for an individual bank to provide the financing because the sheer scale is too large. So you actually need to have a very large scale financing that cannot be provided only by the domestic market even. And then on the other extreme of the spectrum, you've got the subscale transitions in SMEs, where often the effort that you need to make in terms of understanding the transition and the just elements of that versus the scale of the financing is not in sync. And that's a challenge that one need to overcome. The concentrations on both ends of the scale, the very large concentrations and the subscale elements of the just transition. The third element that banks are grappling with is ESG pricing, or the pricing of externalities. There are international benchmarks in terms of the discounts that one should apply in terms of pure environmental factors. So you can reference a series of deal bonds and get a sense for where that is priced. The issue with that is it is often only investment grade, while fundamentally we operate in a sub-investment grade country and continent. And the second part is it typically captures only the environmental side. The social aspect, which is inherent in the just transition, is not something where there's a clear reference point in terms of how should pricing work for that. And as a consequence, if you want to price correctly on a bilateral basis or bond issuance basis, it is very difficult to gauge with accuracy what the price adjustment should be for these externalities down, or for the externalities up for those areas that is not transitioning. The fourth area is one that was touched on by Deepak, and that deals with debt capacity and debt capacity constraints. In the South African context, the transition contains both private sector and public sector. And in particular, some of the anchor entities, such as Eskom, is more challenging from a debt capacity perspective. Likewise, if you're looking for sovereign support, there are limitations in terms of the amount of support that can be provided from that side. So debt capacity in terms of the scale transition, in particular in terms of the just element of that, the social element is a constraint that needs to be navigated. The fifth one is we spend a lot of time in terms of thinking how existing industries should transition. And maybe we don't spend enough time in terms of new technologies. There was a very insightful recent McKinsey's report that identified 24 new industries with particular relevance to Africa. And what that brought home was that perhaps one should spend more time on that and not transition an industry that is potentially no longer viable in the long run, but look for replacement of that. That's especially important in just transition because of employment generation. More time to be spent on that, more research to be spent on that. The last point that I would like to touch on is financing scope. If you look at the just transition, there's infrastructure elements, there's electricity grid elements, and many commercial elements. The banking sector is very well placed to provide the financing of that. There are social elements where the banking sector, while certainly deeply cognizant of the need for that, may not be able to provide the financing for that because those are more developmental finance in nature, even donor finance in nature, concessional finance in nature. So blended finance solutions are what need to be navigated here. So that in a nutshell, Saul, is where we see the key issues: the multiple pathways, the concentrations, the pricing, the debt capacity, the new industries, and the financing scope.
Thanks, Gert. I think that, it captures some of the complexity in quite a neat package. But I think some of the way that we have to think about these things would still need to be unpacked. And let's see if the other speakers are going to be able to give some insights on that. So then let me hand over to our next speaker, who is Sana Mehra, who's the EMEA Head of Sustainable Debt Capital Markets at Citigroup. Sana, over to you.
Thank you, Sol, and good morning to everyone. My perspective is coming from a debt capital markets perspective. So what products are essentially available that we can help our clients finance their transition strategies. So in 2021, we've seen over 750 billion of issuance in sustainable bonds. Now that's green, social, sustainability, use of proceeds transactions, as well as sustainability linked bonds and transition bonds as well. And to put this into context, that's nearly 15% of all euro and dollar benchmark issuance that we've seen this year. So it's a very meaningful part of bond markets now and a funding option for treasurers. And actually, over 22% of this issuance has come from emerging markets in 2021. So it's no longer just an option for frequent investment grade, potentially Western European issuers, but it is a funding option for global treasurers across the world. And now focusing on how could these sustainable financing options help actually finance the transition. And what we found is in the past, issuers have found it difficult to finance transition assets through the issuance of green and sustainable bonds, as these don't naturally fit within investors' green or sustainable portfolios, because a lot of investors may have straight exclusions for fossil fuels, because transition assets can sometimes, most often actually finance lower carbon, but potentially still fossil fuel assets. And that doesn't fit well with these green portfolio mandates. But I think over the last year, we've seen the emergence of this new product, a sustainability linked bond product, which comes also from the loan market. We've seen sustainability linked loans. And this focuses less on the transition assets and more focuses on the transition strategy of issuers. So through the issuance of these sustainability linked bond transactions, what we can help our clients do is really communicate their transition strategies, including their commitments, their CapEx plans to achieve the transition, and including how they could potentially incorporate the just transition aspect of it as well. So not just looking at environmental KPIs, but adding to it social KPIs, which could include potentially retraining of workforces, also providing low carbon energy to underserved populations. So really incorporating both the energy transition as well as the just transition side of things into these transactions. So although we've seen, I think, overall challenges in the use of proceeds market in financing transition assets, I think the sustainability linked bond market, as well as the sustainability linked loan market, is a really useful tool that investment banks can help provide to our clients to really position their transition strategies up front. I also think a second aspect is ESG and ESG engagement with investors and facilitating that. More in my position, when I speak to investors, they are crying out for, there is a lack of ESG related disclosure out there, and it's they're all crying out for ESG engagement. They don't just want to see, or they don't just want to engage with our clients from a credit perspective, but really what are their transition strategies? What are their sustainability strategies? How do they tie into their overall corporate strategies? And they're building their portfolios on the back of that. So really facilitating that dialogue between our clients and investors, and not only from a credit perspective, but also from an ESG and transition perspective. Thanks, Sal.
Thanks very much, Sana. It strikes me how the issues you raise very much complement what Gert was talking about, and the linking of the big projects and the big financing to the small transactions and the small activities that need to take place, and how it's possible through both reporting requirements, ESG, and also putting it in the term sheet that if you're going to be financing this, you also have to do some things that are going to be supportive of a just transition and not just climate finance. So I think the risk reduction measures can be hardwired into these approaches that we take. Let me then hand over to the next speaker, who is Kevin Anderson. Kevin is the head of strategic initiatives at Climate Fund Managers. Kevin, over to you.
Thank you very much, Saul, and good morning to everyone dialing in. I'm going to put on a presentation just to quickly give you some background as to what we do. So yeah, as you mentioned, I work for Climate Fund Managers. We are a Netherlands-based fund manager and really embrace the idea of blended finance. And as Deepak and Gert have both mentioned, we believe that blended finance is quite a unique solution to the challenges we face. So what I'd like to do is maybe just quickly show you how we've approached it, just to put some context to it, and how we actually practically dispersing blended finance in emerging markets. So let me just see if this is working. So basically, Climate Fund Managers is an entity that was set up between FMO, the Dutch Development Bank, based in the Netherlands, and Sanlam Infraworks. I'm sure most of the people dialing in are well acquainted with Sanlam. And to date, we've set up two funds, Climate Investor 1 and 2. Climate Investor 1 being our renewable energy fund, and Climate Investor 2 being a water sanitation and oceans fund, also focusing on the challenges that we face there. The vision of the business really is to look at all different types of climate finance orientated challenges. So energy being the first one, water sanitation and oceans being the second. And in the future, we look to raise similar funds to look at landscapes and resilient cities. In essence, we are a Netherlands-based company, even though you can notice from my accent that I'm South African. But we have offices in all developing markets. So our head office for Asia is based in Singapore. Then for Africa, we've got a team in Cape Town, and more recently opened offices in Latin America as well. Moving on, in terms of blended finance, of course, there's different ways of doing this, but we've reached out to quite a broad spectrum of investors. On the one side, you of course need your donor community to step in and provide that essential donor money. And we have been lucky today to have attracted funds from the likes of the European Union via the European Commission, the likes of the Green Climate Fund, FMO and quite a few other DFIs, and at the same time also got money from institutional investors. So that really has given us a very solid platform in terms of mobilizing the blended finance into projects. Specifically looking at renewable energy in developing markets, this really is the crux of our business. So on the left hand, you'll see a diagram or schematic in terms of how we approach different projects. You'll notice we have a development fund, we have a construction equity fund, and then a refinancing fund. And that really is the basic dynamics of what we use to mobilize funds into different types of projects. And I'll do a bit of a deep dive on that now. Primarily looking at the solar, wind, and hydro sectors. And as I mentioned earlier, very much active in Asia, Africa, and Latin America. So how do we do it? So this is basically what it all boils down to. So the development fund, I think, is absolutely critical in the way that we approach projects. The development fund is really there to provide that essential working capital to various different projects at risk to try and see if they can reach financial close. So often what we found is that there are many people running around with different ideas and different projects, but they don't have the necessary capital to get those projects to close, and it also dilutes their time. So for us, we use the development fund as a vehicle to provide that working capital, with the intent that we're hoping that, of course, those projects will close. If they don't, it's a high risk fund. It's almost venture capital type of funding that we use, but essentially, that money is there to get more projects off the ground. The moment a project reaches financial close, we end the work of the development fund, and we introduce what we call the construction equity fund. And this is where the blended finance nature of our business really pivots around. You'll notice we've got a tier 1, tier 2, and tier 3 type of investor sitting there, each one with its own risk profile in terms of the type of return that they would want to see. But really what we've done here is blended all of that to get to a solution that really could make projects more viable. Then ultimately, once construction is finished, we end the work of the construction equity fund and we move into the refinancing of debt. Now, the reason we've set up this structure is quite simple, is that we believe that historically projects don't see life because the fact that it takes too long. Project finance, as we all know, is a very complex process, and we're trying to avoid the complexities of project finance. And I think a good case in point would be a recent project in Kenya, or not recent, it's up and running now, but the Lake Turkana wind project, which is a 300 megawatt project there. From the day of discussions till financial close, it took, I think, close to 10 years for that project to come to life. And that's just a function of the complexities of project finance. So we looked at that and we realized that that's not going to help the cause. If we're looking to speed up the process, then we need to move a bit faster. So hence the reason why we take a bit of an all equity approach and to avoid the complexities of project finance. And how do we do it? Quickly touch on 2 examples. In Asia, we invested in a company called Cleantech Solar alongside Shell. And once again, this showcases Shell's transition away from oil and gas already into the renewable sector. This is a portfolio of 600 megawatts of rooftop solar that was constructed or is in construction as we speak, but will be done within 3 years. So that showcases that this can be done at a very, very quick pace. Now, 600 megawatts, to put it in context, to do that in 3 years' time, that's about a third of the megawatt capacity of what Coburg provides in South Africa. So, if you have the right finance vehicles in place with the right attitude, then it showcases that these things can be done fairly quickly. So, a good example of how the finance solution we bring to the table can be used. And then finally, just touching on a second example, we have recently financed a project in Djibouti. Now, Djibouti, of course, is not necessarily an easy place to do business, but alongside the AFC and FMO, we have developed Djibouti's first wind farm. It's a 60 megawatt wind farm. It's in construction and will be commissioned fairly soon. And just showcases that once again, with the right attitude and the right partners, this can be done. So that basically is, just a quick snapshot of who we are and how we work. As I said, it's a blended finance solution that we think is perhaps a good way to help with the just transition. Thanks, all.
Thanks, Kevin. I mean, it really does highlight the number of players that are out there and the importance of the partnership. I think it's come through in a few comments already, and certainly came through when we did our research and engaged with a number of players in the finance sector, that it's going to require many parts of the finance ecosystem to get involved in supporting this just transition, and in different ways. So part of it is climate finance, but also how we take it to supporting the communities that are impacted by climate change, and also by the transition away from coal and other fossil fuels. So then on that note, let's move on to our next speaker. And we've got Karel Nerop, who's a fund manager at Triodos Investment Management. And I see that they do work with your organization, Climate Fund Managers. I noticed them on the slide deck. So they are partners already, and there is clearly an approach of collaboration and working together on these projects. Karel, over to you.
Indeed, good morning, and thanks everyone for having me here. And good to see Kevin here. And indeed, we are invested in climate fund managers in one of their funds through one of our funds. So that is there's a nice bridge to the presentation here as well. I'm also going to share my screen and share some slides with you, which should be visible now. I'm going to take a similar approach as Kevin did, just to not go into the specifics on South Africa. I'm not an expert in the market there, but really give you an example and tell you the story of what we do at Triodos Bank, and hopefully provide some inspiration on how that can be done. Very shortly, Triodos Bank, where I work as a fund manager of one of our investment funds, is a bank based in the Netherlands. We're a bit of a strange bank, if I may say so. We're only focusing on investing in sustainable solutions. And we've done that for the past 40 years. And 40 years ago, this was considered hippie banking. I think now people are realizing that we might be onto something. We really believe that with finance, you can address society's biggest challenges, and that finance has a role to play there. And that's why we really invest 100% for positive impact. Sounds easy. It's not. I realize that, and you also realize that hearing the speakers that were before me. But we've managed to build a portfolio of over 20 billion euros in assets under management, divided in a couple of things: retail and business banking and private banking, where we have over 700,000 clients banking with us. We have an investment management arm, which has over 6 billion in assets under management of the 20 I mentioned. And a fairly new arm is, let's call it the blended finance space, where we have proprietary money of Triodos that we can use as grants or blended finance instruments in things that need that type of money. So in terms of risk profile, we are an organization that has your traditional banking space, but only focused on sectors including nature and food, renewable energy, and social inclusion, financing businesses in 5 European countries. We have Triodos Investment Management managing funds in investing in over 50 countries globally, with over 750 direct investments. We do this both in the listed space and the non-listed space. And then we have kind of a grant arm, which is smaller, but very catalytic in the type of things that they do. So not making it too much of a personal commercial about Triodos Bank, I wanted to shift to an example why we invest in the energy transition. It is probably the biggest challenge, if you would label it, for society currently, but it's also a huge investment opportunity. And I think I'm probably preaching to the choir to highlight all the things, what the risks are of the current situation, and why we need to change the system and go for an energy transition. This is already highlighted by Deepak earlier, and I couldn't agree more. We are at a crossroads now, and we need to act now. On the other hand, if you look at the opportunity that it is for finance, and finance is a means to enable the energy transition. We focus a lot now on emerging markets. Why? Because 90% of global electricity demand growth comes from emerging markets in the next decades. There's a low share of renewables in the total production mix in emerging markets, ample resources, population growth is highest in emerging markets. The link is there. There's people with no access to electricity. And one thing I would like to highlight, this is not just utility scale projects that we need to focus on. the International Energy Agency assesses that roughly 50% of new access to energy solutions should or can come from standalone and mini-grid systems. So these are more innovative companies, not your utility scale projects with tens or hundreds of megawatts installed, but innovative companies, which are increasingly becoming mainstream. This is the picture that we have very high level on the energy transition. Now, what do we do with it? We started already 30 years ago with financing windmills when no one was doing it, or very little. A windmill was about my size, given that I'm quite tall, but still. The size of the windmills have increased, but also our exposure to the energy sectors. Since 30 years, we've invested over 2 billion in renewable energy. We've become the global lead arranger by number of deals, not so much in size, but number of deals for the past 6 years. And we've built really a dedicated team with renewable energy professionals focusing from banking products, but also investment management products. So I think this is more as inspirational, but my last slide is really what I would like to bring across. There's a lot of technicalities we can discuss and we should discuss, but our chief economist recently wrote an article on the challenge that system change, including energy transition, brings, and the trouble that people have with grasping it. But in the end, what I would like to bring across, we shouldn't wait for Superman to do this. It's up to us to make a change here. That sounds very high level and idealistic, but it's still true. There's a lot of change makers here in the panel, but also in the audience, I would say. It really doesn't start with Superman, it starts with super ambition. We've, as a company, decided to focus 100% for efforts on sustainable solutions, including renewable energy. This is a challenge and a target and a leadership that also other banks can't show. There's challenges, we can work together on that. I invite people to reach out, but it really starts with an ambition to do so, and that's the mindset I would like to bring across for people to linger on. And I'll stop there.
Thanks very much, Carl. I mean, one of the things that impresses me about the work that you're doing is that you've been doing it for 40 years. Well, your company has been doing it for 40 years. That's a long-term commitment to an issue that I think has only really become popular in the mainstream in the last few years. So I think that's really impressive. But also, I mean, how we think about the opportunities that you raised about leapfrogging with the new technologies to give energy access, and the importance of energy access in creating economic opportunities for people. A few years ago, when we first started with our load shedding in South Africa, we made the comment that you can't have industrial development without electricity. And we've seen how the lack of electricity has held back our economic growth and opportunities, but also how it impacts on a household and small business opportunities that emerge when you do have energy access. So I think the synergies between the big wind turbines and giving people the small scale access is really, really important and useful. Let me then go over to our next speaker, who is Thomas Vertula, hope I'm saying that correctly, who's the CEO at OP Asset Management. Thomas, over to you.
Thank you. That was close enough for sure. Better than most can do when they come from not when they don't come from Finland. Good morning, everyone. Thanks also for having me, and really great presentations and discussions. And it's now a bit difficult for me to try to find something fresh, but I'm trying, and I will be as concrete as possible. But I will begin with kind of reassuring what was said in the beginning regarding this situation and the IPCC report actually making a difference here. I think so as well. I represent OP Financial Group from Finland. We are the biggest financial group in Finland with market shares between 20 and 50% in everything we do: corporate lending, mortgages, fund management, and so on. And I think I can feel it and see it in my organization, and also in discussions with some of the peers and competitors as well. it seems like now also the broad financial market needs to and wants to be a part of the solution rather than kind of still figuring out how to go about the whole sustainability thing. And one other notion is that I come from a country who has decided to go for net zero carbon neutrality by 2035, which is quite ambitious, very, very difficult, but still says something about how we think about things. So when thinking about funding that the banking sector can arrange for these projects, I guess it's three types. It's bank balance sheet lending, which is probably the lowest probability because it comes with lowest risk tolerance and also the highest barrier when it comes to regulation and capital requirements. So that is at least from my point of view, especially when thinking about lending cross-border, that's probably the lowest probability. And then we discussed bond and debt issuance. That is a good way to get funding if the entity looking to issue bonds actually can have access to the markets and can kind of sponsor the risk, whatever it is, so that people will invest. But if those bonds are available or debt, loans, then for sure there is demand, and we as asset managers could also easily think of investing in something like that. And then of course the asset management sector can be able to provide all kinds of vehicles, cooperation, and the highest risk tolerance capital available for these projects. And that is what we have done as well. We have partnered up with FinFund, a local development financier, to create an impact fund together, to have kind of all the aspects needed from an investor point of view, which is something that I think cannot be avoided. And these three things are the three dimensions are risk, return, and of course measurable impact. So if all of those are in balance, then funding will be a lot more easier to achieve than if there is something questionable going on that side. And someone mentioned that risk management should be somehow, or risk measurement should be somehow renewed or done in a different way, and that to me sounds like let's say that I would challenge that notion. Risk management, I guess, is pretty standard stuff, and if we are able to assess risk based on traditional standard measurements, then it's a lot more easier to attract funding than with a new risk management measure developed for something like this. But in order to kind of sweeten the deal for investors or lenders in these projects, and I'm trying to understand the project level of this, where the funds would be invested, would be that the blended capital was mentioned here. I was thinking about, for example, private-public partnerships where the public funds or sponsorship would kind of leverage the return for those private assets that come with a return requirement. Then even kind of poorer projects or projects with a low return could become viable for private investors and private capital as well, with typically a higher required rate of return. And that also mitigates risk if there is a good sponsor, even a government involved in these funding structures. The projects need to be real. They need to be able to be analyzed one way or another, and that applies both to risk return and also what kind of impact there is. And the good thing is that measuring impact, I think there's good methodologies already available for that work to be done. The SDGs offer something, and there's good data. Of course, not in these kinds of projects, but the methodologies I think can be applied, and certainly with FinFund we have been able to come up with numbers and analyses that really support the investment decision. But there needs to be transparency. Otherwise these things cannot be really analyzed, and then the investment decision making will be very, very difficult. And then there was a notion in the brief that the project pipeline may be poor and the project may be small. So if it's a poor pipeline, then I don't think anything can be done. But the good thing dealing with private assets is that I believe that then whatever comes above the hurdle of private assets being invested, that improves the quality and longevity of this transition as well, and the impact that is created. And then many small projects actually can be a good thing, because that improves diversification. But of course, then there needs to be some sort of a platform where those already are available, especially for an investor like we would be. So yes, risk, return, and impact, those cannot be avoided. They need to be in place for private capital to be attracted to these investments. But luckily, there are ways to manage that, and probably it's about cooperation together with the private sector and also everyone else involved in order to make this as attractive as possible. Well, thank you.
Good, thanks very much. You raise a number of very, very important issues. So I'm hoping to see some questions popping up in the Q&A, particularly as how do we think about return? Typically, impact investing has been, accepting of a lower return, accepting of a longer return period. So some of those issues, hopefully we can get to discuss in the discussion after we have our last speaker. So let me then hand over to our last speaker, who is George Harris, who's the project lead of PACTA for banks and at 2 Degrees Investing Initiative. George, I'm very curious as to what you've been doing. It sounds very impressive, and I'm looking forward to your input. Over to you.
Great, thank you so much, and good morning, everyone. I hope you can see my slides, and I assume you can. Great, so very quickly, 2 Degrees Investing Initiative. We're an independent research think tank, so we're funded by we're not for profit essentially, so we're non-commercial. We maintain our independence and our neutrality for our kind of multi-stakeholder governance, and yeah, we're kind of research led. And what we've developed over the past 4 or 5 years now is a tool to allow financial institutions to measure their alignment to climate change scenarios. This focused mainly on the climate, and I'm going to present how this works very quickly now. And then I hope to point out how this can be used in the context of the just transition towards the end of this very quick presentation. So what is PACTA? PACTA stands for the Paris Agreement Capital Transition Assessment. And it takes a data set in the real economy. So on the right-hand side here, we can see these kind of climate critical sectors. So the oil and gas sector, automotive, power sector, coal sector, aviation, steel, and cement. These are not the only sectors that climate change are critical to climate change, but they're some of the key ones. Shipping is in the pipeline, and 2 that are kind of missing from this would be, or the most noticeable ones would be agriculture and also real estate. Doesn't mean to say we don't think they're important, they just don't quite fit into this framework I'm about to describe. So what do we have? We have these physical assets across these sectors in the real economy. We know what their production plans across different technologies are in a forward-looking manner. So this is based off capital, of CapEx, of business intelligence data sets. And we can tell you that one asset is going to have megawatts of renewables being brought online in the year 2023, for example. We then map these assets to the companies that own them, then the companies that own them, all the way up the corporate ownership structure. We then map those companies to the financial portfolios that finance them. For example, we have PACTA for investors, which is equities and corporate bonds. And then we have PACTA for banks, which is corporate lending. The way in which we do it is slightly different, but I won't go into details of that for now. So then once we've mapped these assets in the real economy to your financial portfolio, we need to benchmark this against something and compare it against climate change scenarios. So I'm going to quickly explain what climate change scenarios, what we mean by this. So the climate scientists kind of define carbon budgets. So we know that if we're going to achieve net zero or the Paris Agreement, we can release X amount of CO2. This is correlated to a temperature rise. We then know that society and the economy has to evolve. We're going to have population growth, economic growth, politics is going to change, demographics, etc. The point I want to make here is I think the just transition is not so well captured within these scenarios. So just bear that in mind as we move to the next step. So what we have to do is achieve this carbon budget whilst considering these societal and economic changes. And how do we do that? We break it down into these climate critical sectors and we define sectoral decarbonization pathways. So what does that look like in practice? I'll use a stylized example here. Say that in the world we have 10 gigawatts of coal. Then by the year 2050, if we're going to keep temperature to 2 degrees warming, we now have to have this new technology mix, 7 gigawatts of renewables and 5 gigawatts of coal. Obviously, you notice this doesn't add up to 10. This is accounting for the population and growth in general. So here we can see like sectoral decarbonization pathways. We can see how the sectors have to evolve, and we can kind of define rates of change or build outs of different technologies. So if I quickly jump back to our big triangle here. So we have these assets in the real economy. We know how the companies that own them are evolving in terms of their technology mix and the production capacities coming from those respective technologies. We then compare that to these climate change scenarios to show the financial portfolio which trajectory they are on. We do this through these 3 metrics: a technology mix, so per sector, what the technology mix looks like today, and most importantly, forward looking in 5 years' time, what it will look like. Volume trajectory is then looking at how these production capacities are changing in the next 5 years. And then emission intensities can also be given. So quickly, because I know a bit pressed for time. So how can we adapt this and how can we include this in the context of the just transition? So I think PACTA as a tool, as it's bottom up and it's based on these assets, we've got this connection to the real economy. So the real economy, we can start to derive metrics off the back of this that can aid in this just transition story. Also, it's open source and it's iterative. This methodology is it's a public good, so it's free, anyone could use it. And also it's evolving. This is not a black box, it's not a kind of rigid framework. We can improve it as we go along. And this allows for kind of regional considerations. For example, the NDCs of countries can be included within this kind of framework through the inclusion of regionally specific scenarios. Then I think this can help financial institutions to identify and therefore engage with clients. And we see this being used quite actively for this use case. Finally, it takes a sectoral approach. So we're looking at alignment in each sector. So this means that we want to align the fossil fuel sector through the decarbonization pathways that they can follow, the automotive sector, and all the other sectors I mentioned, rather than simply switching sectors. If we see financial institutions divesting from these hard to abate sectors and reinvesting this into, for example, health and IT, which we're starting to see from like anecdotal evidence, this isn't addressing the just transition, and it's certainly not addressing the climate issue in the real economy. So by taking the sectoral approach, we're kind of encouraging the engagement and the steering of sector by sector case, rather than simply switching our asset base. Then finally, just last slide here. how can we kind of continue to adapt PACTA towards a just transition? I think if we can define just transition compatible project finance, this can be added to that data set that I mentioned. So we can start to tag assets in the real economy that are compatible with the just transition. Then we can include that in the data set and we can map it to your portfolios. Secondly, we need these scenarios, these roadmaps, to be regionally specific. The IEA have, like, I think there's an Africa one, but there isn't a South Africa one, for example. South Africa will follow its own decarbonization pathway, and this is influenced by the nationally determined contributions, the NDCs. If we can internalize those into these scenarios, we can start to steer our investment towards this just transition and climate compatible world. So I think that's a call to kind of scenario providers, also policymakers, to put pressure onto scenario providers to provide these roadmaps. Then finally, there was some mention from a previous speaker on kind of the financial products that can be used to help finance the just transition. So I think there's a need for kind of a new metric to be added that captures these new financial products. I think my closing thought here as well is when we talk about sustainability-linked bonds or sustainability-linked loans, we need to be conscious of kind of screening material, like frameworks, I guess, for these products. Like, are these just new terms that we can use to continue financing the old activities of the corporates, or are these new like products that really are going to finance the transition? And to do that, we need scrutiny and we need accountability. And I would propose that a forward-looking capital expenditure metric can help to balance this out. So I think inclusion of just transition compatible financial products, for example, sustainability linked bonds, is a great way forward. We just need to like scrutinize what we mean with these so as to ensure this just transition really does happen. And I think I've overrun, so I will stop there. Thank you very much, everyone.
Great, thanks, George. I mean, you point to some of the key issues around how do we understand the just transition and how do we try and develop a taxonomy or categorization of what is a just transition, so we can start putting it into our reporting and our metrics. And given that a lot of the discussions around the just transition, although they started 20 years ago, they've only really taken off in recent times. We are trying to, in our own work, we're trying to get our heads around those very issues. Let me open up and ask all the panelists to turn on their screens so that we can move to the panel discussion. We've got some questions in the chat, and we've got one question in the Q&A. So I would encourage the participants to add their comments, questions, so that we can have a discussion on some of these quite useful discussions. I mean, I'm thinking about the depth of discussion we've had today and raising some really, really important issues. So the first question is from Nick, and I mean, the issue is, you know, we can all see it on the chat, but the issue is, are we technology agnostic? You know, when we're looking at financing climate change and just transition, you know, do we say some technologies are better than others? How do we think about gas? It's not coal, but there are some environmental impacts of gas. And if we're thinking about the long term, you know, where does gas take us to in terms of, you know, if we move away from it in a few years' time, do we end up with stranded assets? How do we think about these in a financing context? Anyone can put up their hand and go for it if they want to respond. Deepak, go for it.
Yeah, I'm gonna cover maybe the first part of your question. We have the IRP, and there is now a general consensus that IRP needs to be revised. Of course, the process through which that 2019 IRP does get revised will be a function of what primary energy sources go into the mix, at least in the next medium term. In that context, I can say that in South Africa's case, certainly there is a growing consensus that gas is going to be an intermediary solution to a decarbonization process, which sees the, if funded properly, sees the accelerated decommissioning of coal-fired power stations in the Eskom fleet. And I think to COP26 is going to go a country consensus. That's my sense, that we're going to put on the table a more rapid stroke accelerated decommissioning of coal-fired power stations in order to crowd in whatever grant and concessional funding can be harnessed. And I think grant and concessional funding in the context of the blended finance solutions that some of the speakers have talked about is going to be an interesting part of the discussion. But yes, gas is definitely a part of the mix as a transitory primary fuel, which is cleaner. Fossil fuel, yes, but cleaner than coal.
Okay, thanks, Deepak. Gert?
I would like to add to Deepak's point and also touch on the question that deals with SA policy context. I think we need to be careful not to speak in binaries in the sense that it is absolutely everything or it's none. When you are in binaries in terms of you're absolutely for it or absolutely against it, then often you don't get the nuanced solution that takes into account country-specific context. In our country-specific context, where you're decarbonizing from is very important. And as Deepak has noted, there may very well be a meaningful role for gas to assist in terms of accelerated early stage decarbonization. And then later on, you need to add additional decarbonization. The problem is probably best illustrated with reference to the telecom sector. It is possible, like Nigeria, to jump from no telecoms to mobile fully with by bypassing fixed line. However, that's the exception rather than the rule. Most people go from no telecoms to fixed line telecoms to mobile telecoms. And in the same way, it's difficult to jump from no gas to straight all just renewable energy. Sometimes you need to accept that there's a portion of that. And when you accept that notion, it then all becomes proportionality. If you lock yourself into a different fossil economy, okay, then the outcome is not going to be the outcome that you pursue. However, if you view it as having a nuanced role as an aid in your process, then it may be more attractive, and it may not be incompatible even with the IEA path that is more about exploration of new gas as opposed to the use of gas for a period of time. So it's a very nuanced view that is needed here, and a very much a country circumstantial view that you need to take into account when you opine on these things.
Thanks, Gerrit. George, I see your hands up to respond.
Yeah, just very quickly, I think this is a really, really interesting topic. And I think from this kind of evidence that we've seen, this isn't to contradict. This is just, yeah, just to add to the kind of the discussion, I would say. This has been the kind of the comment for years now that gas is going to be a transition fuel. In a lot of the scenarios that we look at, it is seen that it's allowed to continue to increase. What I've seen recently and find interesting is almost all of the major oil and gas companies are actually decreasing their, not all of them, but most of them are decreasing their production in gas in the next 5 years. Now we have these companies own assets that extract oil and gas. So where is that gas going? Are they shedding their, this is a question, this is not a fact. Are they shedding their oil and gas assets to smaller companies? And if you're looking at that's what I think we need to start to track, is where these actual assets are going. If a major oil and gas company, Shell, BP, Total, Exxon, are decarbonizing their pathways, but those assets are still existing in the real economy, and they're simply switching hands from majors to independents and minors, or smaller companies, what does that mean from an impact point of view from climate change? But also, if you're a financial institution that are exposed to those smaller companies, what does that mean for your risk profile when that transition does happen? So is it a question of changing assets, changing hands? And yeah, I'll leave it at that. Thanks.
Yeah, I mean, I think that raises an important issue because we've seen it happening in South Africa, where the large multinational mining companies have exited, but the assets still remain in smaller companies. And the smaller companies, as was raised in a seminar yesterday, often have less capacity and less resources to support a just transition and to support the decarbonization. So then you are effectively, putting a set of assets that are stuck if those companies, want to cling, because that's their major asset. So I think these are important issues, and it's important to keep track of it. Thomas, over to you.
Okay, thank you. Yeah, well, regarding gas, one notion is that after the IPCC report, I think that what happened is that people are getting okay with the notion that it doesn't need to be black and white or only purely green and then everything else is brown, not tolerated. So we talked about the transitionary solution for gas, and I think there is a lot more acceptance towards thinking like that now for some reason than before, and then gas could be a solution in that, and should not be avoided based on that, like it has seemed a little bit before. But then again, someone talked about where the gas is going to, and I'm thinking about where the gas is coming from, and this is a European point of view. It makes it a little bit more difficult to invest in gas-related things because there are, well, geopolitical tensions around that, where it comes from, and what these countries are doing with the assets they are getting for selling the gas. That's one aspect. But yes, I think gas should be included, and I guess will be included as a transitionary thing. Policy response, just a quick response on that. If the capital requirement is lower for sustainable lending and investments, then for sure there is a lot more funding available, and that is a political decision. Even if these Solvency II regulations and Basel 2, 3, 4, whatever the next number is, even if they are in general okay from a theoretical point of view, I'm not sure if the specific levels are just right. So there should be room for a political decision as well to endorse sustainable funding and investments. And then the last thing that I saw my name there, yeah, the platform. I think for me, or an asset manager, in order to invest into a number of small projects, especially in another country, then I would probably want someone to manage a portfolio of those projects. So that would be the platform. Someone who has the capabilities would be there to making sure that these projects are managed in a proper fashion. Probably this intermediary actor would somehow be able to combine those projects into the portfolio that they have expertise in, and in that way it would be a lot more easier for me to make an investment decision. And one example of what we've done here in Finland is that we have now set up a local infrastructure fund, and we have, for example, done joint ventures with operators in order to make sure that if we find a portfolio of different kinds of smaller things, there's an operator who can make sense of those to ensure that they are managed in a quality fashion and the returns are there. So that we as investors don't need to try to be expert on that thing as well, because it's not possible for us. So those small remarks at this point. Thank you.
Thanks, Thomas. I mean, that raises an important issue about the need for smaller funds, because I mean, what we've seen in our own work is, there's a lot of global finance, but when it comes to those smaller transactions, it's very expensive for a global player to start looking at a 50 million rand transaction. What that would be, just over $3 million. It would be a tiny, transaction. So how do we think about those intermediary funds and the role that they're playing? But before I get to you, Deepak, I want to just touch on what Georgina was saying in her question, because, you know, turning it around slightly means that what are the policy blockages that we have? You know, what needs to be done differently by the South African government to say, okay, this is what we can do in order to enable financing of a just transition. So maybe it is creating the space for some of these intermediary funds, but what are the other blockages that we see? Kevin, you in one foot in South Africa, maybe you've given some thought to some of these issues, or Sana, you're looking at these issues from a global perspective. You're sitting looking at multiple markets. Do you have a view that there's something that needs to be done differently in South Africa in order to unlock some of the finance required? Let's start with you, Kevin. Sorry to pick on you, and then I'll move over to Sana.
The best example I can think of, currently, which we are witnessing, is the huge tsunami of green hydrogen that's evolving globally. And from a European point of view, we know that to achieve the targets that have been set, that green hydrogen will play an important role there. To make it more specific to South Africa, and I can just compare what we're seeing South Africa versus the likes of Namibia. Namibia is racing ahead in terms of getting their policies and regulatory environments in place. They've already issued their first RFQs. I don't think South Africa is there yet. So those are the type of things that one needs to think about. To what extent does one need to see the bigger picture and participate. Namibia is blessed with renewable energy resources that makes it attractive for green hydrogen, and so is South Africa. So those are the type of things that one needs to be think about. How does one participate?
Okay, that sounds good, Sana.
Great, thanks. So perhaps I'm not an expert in South Africa, but potentially what I'm seeing is good policy coming out of Europe. I think in terms of the EU taxonomy, in terms of the pressure, all this raft of EU regulation that we're seeing, which is affecting both issuers and investors, and in particular the investor. I think issuers are going to go where the demand is, where the money is, and with the sustainable finance disclosure regulation coming in, so really mandating all investors to speak about how, or be very clear to the market about how they integrate ESG into their portfolios with the Article 8 regulation, and then also Article 9 on really creating sustainable investments. So I think, most investors that we speak to are now saying they're going to go from Article 8, which doesn't have any ESG factors within it, to from Article 6 to Article 8, which integrate ESG within it. And that's really going to then spur on issuers, because they're going to need to increase ESG disclosure. They're going to need to enhance their sustainability and transition strategy. So we're really seeing that, if we've got regulation potentially targeted at the investor community, could potentially, that's where issuers are going to follow the money, the demand, the investment.
Thanks very much. It raises important points about the role of a banking regulator and the role of a national treasury in helping to shape that framework. So I think it is useful. And Kevin's, your point is, we need to get the Minerals and Energy Department fired up around, driving these new technologies so that it becomes part of what we can see is a long-term financing plan on these new technologies, and there's a business case for it. Deepak, you had your hand up earlier. You can go now.
Yeah, thank you, Sol. I'll try to be brief. Sana has raised an important issue, which I don't want to disagree with Thomas, but Thomas said something about risk management and risk measurement not needing to change. I'm really sorry. We're in a developing country context. Our market is very different to what you might be accustomed to where your current exposures sit. And to Sana's point, I think what we need is to start incorporating what I would call the externalities into the mix. And I don't think in South Africa, in terms of our banking system, in terms of our risk measurement system, which then finally, I understand bankers speak, requires a return on investment, a return on assets, or a return on equity. I understand all of that. And I think in that area where we finally come out with what are financeable projects, what are financeable portfolios, we do need, in some respects, to get a risk management framework in South Africa, which maybe approximates what might be happening in Europe, but we've got our own development path and our own trajectory to getting the market mechanisms in place according to our very special set of circumstances. With respect then to technologies, I agree both with Kevin and Saul, your comments, that we need to find a mechanism through which to embrace emerging technologies. And I know this is going to sound terrible to free marketeers, but we need to find a way of ensuring that our own industrial policies benefit from what I would call localization of technology content. It can't simply be that every single solar panel which gets installed in a solar PV field gets imported fully built from China, for example, right? So there are very difficult sets of trade-offs and choices in the policy mix, which go all the way from banking and banking regulation, risk measurement, mitigation, as well as management, ESG as a governance framework, and then finally, of course, our own industrial development policy, which sees a shift away from the stuff that is polluting, i.e. coal, maybe through a transitory mechanism, which is gas, but finally takes care of our real natural endowments, which we know exist, which is wind and solar. In fact, we sit in the upper quartile of wind and solar, let's just call it natural endowment, compared to anywhere else in the world. I'll stop there, so thank you.
Thanks, Deepak. I mean, you raised important questions around linking these issues to industrial development. I mean, that we seeing as core to how we can make a just transition work, where you're creating the economic opportunities through the new technologies, through the investments. These are important synergies that need to be brought out and put front and center in our debates and discussions. Thomas, I see your hand.
Yeah, thanks for the challenge. Yeah, I think the part of the cooperation needed is that we make sure that we speak the same language. So yes, your point noted, and probably it would be easy to find a kind of a common ground in understanding risk management. Then to the other point, I mean, this cooperation and public-private partnership kind of thinking. For example, these solar panels, and if there is a need to produce those in South Africa or locally anywhere, because of all kinds of reasons relating to China, I think that would be easily possible when there is a government sponsor making sure that it becomes viable also for the private sector to invest in that. Then for sure there will be help in terms of funding and maybe also in running the factories and things like that. So that this is kind of what needs to also happen, so that we understand each other, or all parties involved understand each other, and the common goal is to make these things happen rather than anyone's individual goals only. Thanks.
Thanks very much. And we look forward to picking up those conversations. I think it's this panel discussion is not only about sharing ideas, it's also what we used to do in the past, have conferences and meet each other so that we build the networks and we can then take these discussions forward. So I am hoping that it's not just about the discussion, but it's also around the connections and looking forward to some partnerships and long ongoing discussions that need to take place. We're coming towards the end of our time on the seminar. So there was still a whole range of questions that have popped up in the chat. Some have been answered. But what I want to do is just do a quick summation from each of the panelists. If you're welcome to touch on questions that have come up in the chat while we've been talking, but also just give your last few comments on the discussion that we've had today. So I'll take us in order of people who've spoken. Deepak, you were first. Sorry to throw you in the mix, but you've got about 30 seconds to a minute to just give your concluding remarks.
I'm going to give my 45 seconds to Thomas. I've said what I needed to say. Thank you very much.
Thanks, Deepak. Gert, you were next.
Thank you. It was good to hear all the perspectives here of the role players. I think what one certainly need to do as one journey forward is to link these various role players tighter into the ecosystem. All of these elements are needed for us to successfully finance a just energy transition.
Thanks very much, Sana.
And so I actually have a question to potentially leave the audience with. It's also in the context of just transition, I think some of the discussions that we've been having internally is also whose responsibility is it? So if you are retiring coal power plants, for example, is it the company's responsibility to retrain the workforce? Is it the government's? We need more clarity, and potentially, again, I think to Deepak's point, this public power, public-private partnerships are potentially, the way forward. But, really, we need to drive whose responsibility and what kind of partnerships could help companies finance or, move forward with this just transition.
Thanks very much. Kevin?
Yeah, I think, I'd answer in two ways. On the one side, I think, South Africa there's a lot of interest in South Africa. We look at the amount of European companies dialing in to participate in this call, and you see there's a lot of interest in the country. So I think definitely, great interest there. Secondly, I think is, one should perhaps think about not necessarily always relying on government to set out the programs. Like we know in South Africa, the REAP program is immensely, successful. But at the same time, the lifting of the megawatt capacity to 100 megawatts also allows for the private sector to get involved. So definitely a win-win situation, and I think a good platform to build from.
Thanks, Kevin. Carl?
Yeah, thanks. I just wanted to reflect on one of the comments made on aggregating smaller projects and how that practically could work beyond the fund-to-fund. One of the other options, which I think was also mentioned, is really following corporates in their transition to renewable sources. We, for example, partnered with Heineken to put solar panels on a lot of their distribution centers, and also partnered with a developer in that sense. And that is a setup that we initiated as a bank or as an investment manager. And I think there's a lot to be gained there. If you go down the value chain, the assets are there, the ground is there, the roofs are there. With a developer, you can develop solar, and aggregation makes sense, and it's scalable, and it is a way to fund it for a bank or an investment company as well. That's a practical example on how you could do that.
Investment companies and banks being proactive, I like it, and I think it signals a shift that we're going to have to look at, and something that we've also picked up. Thomas, your last words, and you've got a few seconds extra that Deepak has handed to you. Yeah, thanks for the gift, Deepak. Well, let's see if I can use this. So first of all, I think what is important is that the willingness is there from the finance and banking sector to be a part of the solution, but the main or the basic rules are not changing. Risk, return, and real impact need to be there. But then perhaps the levels can be a little bit different from a standard commercial investment when it comes to these kinds of projects. But the good thing also is that I think we are now kind of aligning interest between let's say the public actors and the financial market, and now in between a standard more broad-based asset manager or bank like OP, there are these specialists now who are represented here, and also FinFund, who are able to kind of fill the gap between someone who may have more assets to invest, but not a real understanding and knowledge of the target economies or projects. So if we get all the interests aligned and actors aligned, then I'm sure a lot will happen. I think we are getting there. That sounds good. George, you've got the final words.
Great, thanks. I think I have a slightly different angle, coming more from the metrics and the measurement of this sort of thing. So I think when I give these sort of presentations in a developed markets kind of context, a lot of what we try to argue and put across is about this connection to the real economy and this need for impact and change in the real economy, as opposed to just divestment and cleaning our portfolios of risk and the such, but actually changing and steering in the real economy. I think this is kind of different in the case of emerging markets, and I think the main reason is this notion of just transition. So I think the just transition inherently ties the financial institutions to the real economy, because that's where we really need to drive the change. So that's kind of my closing remark, is that it's a unique, well, it's a different way of thinking about it. And I think that the just transition, really ties us to this impact on the real economy, which I think is great. I think as metric providers, we need to understand regional contexts as well. I really encourage, I'm kind of speaking to myself here, but for people like us to work in the regions we are, and not to apply models that have been developed in developed markets to emerging markets. I think Deepak kind of mentioned this as well. We really need to internalize the regional context. So yeah, real economy, just transition, the link is there, and also an importance on contextualizing models and metrics developed in other markets to the region. Thanks.
Good. Thanks very much. Thank you to all our panelists. Thank you to our funders, the EU and GIZ, who've supported this process and been very active in helping to pull this panel together. Thank you, Ariana, Diana. It's been great to have the series of workshops with you. They are all available on the TIPS website, and we will make this recording available as well as the presentations available. And thank you for great participation from the attendees who joined in and asked some insightful and important questions. Thanks very much, everyone. Have a good day. Bye.